All right, Mr. Turkington, how are you?
It's a great Thursday, bud. How are you?
I'm doing well. I'm doing well. We are going to talk all about mortgage buydowns in an effort for those of you that happen to be looking in this environment. I know there's not a ton of you right
Both
now.
correct. I was going to say both people out there. Too far.
That's all right. I mean, really, let's define the market right now. We have at the upper end, we have our cash buyers still. In the middle end, we have our basically move up buyers or move down buyers. They're not doing anything. And then we have our first timers. And that's what we're going to talk about mortgage buydowns for, is the first time home buyer portion of that's all that's looking truly right now, with interest rates being above 7%.
Yeah. Anybody that has a home is probably sitting tight and saying, my rate looks pretty attractive right now. I'm not sure I want to go through the move in getting into the ideal home with the increase in the interest rate that I'd be paying. So you're right. We got a lot of people hanging out, waiting to see what happens.
All right. So
Can't blame them.
There are bits and pockets and little areas where maybe there is still a food fight for a home, but for the most part, that's died down, which is allowing buyers to get back into homes using seller concessions, which helps immensely not eat up all the savings of the buyer, who is probably doing their best to save as much as they can to make this leap out of renting or out of the parental home into a new home. We are not going to talk about adjustable rate mortgages today. We'll get into that later. We might reference it a bit here in our discussion, but we are going to talk about fixed rate products and fixed rate buy down products, which are an alternative to gives you some short-term relief.
It certainly does.
Go ahead.
No, I think I say this just about every time we come on here, but it's a flashback, right? So as the real estate market evolves and ebbs and flows, loan products go out of favor and then they come back into favor. So we used to do a ton of these back, I think it was in the early 2000s.
Yep.
And what a buy down is it's a 30-year fixed rate. And for either 1 or 2 years, the buyer gets to pay a reduced payment. And that reduced payment is funded by a buy down account. So I'm going to put this graph up because it'll probably make a little bit more sense as I'm kind of describing that. So in this example, the borrower's getting a 30-year fixed at 7.25%, and that payment would be $27.28. However, with a 2-1-0 buy down, the borrower would pay 5.25% for the first year, 6.25% for the second year, and then years 3 through 30, assuming they have the loan that long, then they would be paying 7.25%. So where does that money come from? That's where this math off to the right, the payment difference from 7.25% to what the borrower's paying for the first 2 years, it equates to $9,400, $9,428. So that buy down account needs to be funded. So the borrower's going to make their portion, and then the buy down account is going to pay the balance between what they pay and the note rate. So in this example, they would have the ability to ask for the seller to cover, I'll just round it up or round it to $9,400. And the borrower has the opportunity to take advantage of a cash flow payment that's $520 less than what the actual note rate is.
Okay. So why would they do this? In anticipation that rates may go lower in the future, and possibly do a refinance transaction into either another buy down or another fixed rate product that maybe the rates come down to 6.25%.
Yeah. So what I'm seeing a lot of is that this allows, it's good marketing for the seller. It's certainly not bad for the buyer. In the event that, you'd really like to have a payment that's $2,200 for a year instead of 27, you can use the equity in the home or the seller credit to make up that difference. So it's really a comfort zone. If that reduced payment is needed in order to get in and feel comfortable about buying the home, there's benefit there. The other side, like you said, is, hey, I'm going to refinance in 12 to 18 months. So maybe I would just want to take a lower purchase price. You either get to be concerned about the equity in the home or what your monthly payment is. You just can't get both.
Okay. The other reason people might go this option is they believe that they're going to get a promotion or a pay raise as they move on through their career, and they'll be able to handle that adjusted up payment a little bit easier down the road.
Yep.
Another reason might be they need to make improvements to the home. So they want to take that $519 a month savings, whether it's blinds or appliances or flooring or paint or some kind of required that they believe necessary repairs as they acclimate.
That's a great point. Yeah, they've got $6,200 that they would have in cash flow that they save to allocate towards those expenses or what ifs.
Okay. What other reasons are they coming up with for going this route? To buy down the rate for a short period of time.
It is to offset the recent interest rate hikes that have taken place over the last few months. It gives you the ability to have a little bit of breathing room. One of the questions or objections I've had is like, well, hey, why would I do this if I think I might be able to refinance in 12 months? So in that instance, if 12 months goes by and you could actually refinance to the 5.25% interest rate and have it locked in forever, whatever has not been used from that buy down account, that gets credited towards your principal balance. So you really can't lose by doing this. It's just a matter of how you prefer to do it. Do I want to use, in theory, $9,400 of the equity? So I'm going to pay $9,400 more for the home, or do I want, the possibility of that payment relief for 2 years?
This wasn't even a thing 6 to 8 months ago when we were having food fights and people were bidding up prices above list price to secure properties. This was not happening at all. Interest rates were obviously lower, but sellers were in the driver's seat. So right now we're seeing it come back to the middle a little bit, where you're seeing concessions on
A fair amount of the transactions. Yeah.
3 out of 4, 2 out of 3.
That's a fair number.
Okay. So if they're not using it for buy down money, they can obviously use the concessions to cover their closing costs and their property taxes and their homeowner's insurance. That helps save a bunch of money as well. But if you can take it a step further and go this route, there's a little more bang for your buck as opposed to buying down that 7.25% forever.
Right. So
that's
that's what you're saying. Hey, let me pay points to take the 7.25% and get it down to 6.75%. Right. The bang for the dollar isn't there. So you're right. This has become popular because of two things going on. One, you may have the ability to negotiate a seller credit. You touched on that. The other thing is that you can't read anything right now without saying that there's an expectation that mortgage rates will be lower in the near future. So, it does give you the ability to maybe get in at 5.25% and pay that for a period of time and maybe get that locked in by refinancing in a period of time. So those two things have made this a much more common discussion than we've seen in a very, very, very long time.
Okay. So the start rate at 7.25% on the buy down is slightly higher than the start rate if you don't do a buy down.
No, they're the same.
They're the same. Okay.
They're the same.
So,
Yep.
so if you can't get concessions, then it doesn't make sense for you to do this, probably to
I don't,
fund this buy down out of your own monies.
it's one school, it's a coin toss,
Okay.
meaning that you're going to bring the money to closing and you're going to save money per month. At the end of the 2 years, when it goes to 7.25, you're square, and as if you hadn't done it. If you do end up refinancing, between the money you saved per month and the balance of the buy down, you can't lose. The math is the same either way. It's just a matter of how you choose to pay it.
Okay, so the good news in all of this is you're fixed at 7.25. If rates ultimately never come back down and they hang out in the 8, 9, 10, 11% range for the next 10 years, you're still good.
There's no risk.
Okay, that's the great news.
Unlike an adjustable rate where you have, again, a certain period, but you have chaos after that initial period.
Okay, I love it. I love it. And people can buy it down for a year, or they can buy it down for 2 years right now.
Correct. Yeah, the
So-
2-year buy down is the more commonly discussed option, just because that number is even greater. So,
Yeah.
it's a much bigger impact, as you can see here on a $400,000 mortgage. That's $520 a month.
So we're trying to help folks get into home ownership, and to move away from the rentals and paying rent and moving every 10 to 12 months, or thinking about having to move every 10 to 12 months. A way to break into home ownership and use some of these concessions where, yes, this stuff is it's a lot. It's a lot to digest, but what we're doing is we're sitting down with you before you get into negotiations of what should I even offer on the home. Before we even do that, we kind of go run through these exercises so that you're able to put the offer in and dictate the pace of play to your agent, who then is negotiating on your behalf.
Right. So a year ago, we had fantastic interest rates, and it was super difficult to win an offer or to get your offer accepted. Now we've got an environment where it's much easier to get your offer accepted, but we have lousy interest rates compared to that period of time. So this is a way to say, hey, if we can negotiate with the seller and knock the edge off that for you to help you take advantage of what's good for your family, what's good for timing and a need, this is a way to have options to, like you said, baby step into it or address it, given the assumption that we really want to target a refinance in 12 to 24 months. But
I
you
love
also
it.
said a very, very good point. It's a bit to chew on, or difficult to understand the math. But
It's actually easier than an adjustable rate mortgage to understand.
You can
and-
quantify it from start to finish, right? There's no unknowns.
Yes. As we get into these discussions, we will discuss ARM products with you as well and go through the pros and cons between a regular fixed, a buy down fix, or an ARM to help it make it all sense. So don't freak out. Don't worry. That's what we do. That's what we're here for. If you're watching us on YouTube and you found your way to us, please like, subscribe, and we appreciate you. Everybody have a great day.
Hey man, thanks.
Thank you.